This is PBS.
Hi, I'm Patrick Stoner. I just realized that I've been fundraising on TV12 for...
We're here to make the process easier and faster for you. With me is our studio audience. We're glad to have you all with us today. We're going to test their tax IQ by asking them a variety of tax questions. They will provide us with instant answers through their electronic answering machines placed in front of them. We're also going to give our audience a chance to ask some of their own tax questions, and maybe you'll find in all of this some answers to your questions. We certainly hope so. And here to provide us with the correct answers and explanations in straight talk is our distinguished panel of experts. And they are Claudia Hill, representing the National Association of Enrolled Agents, a group of tax specialists, really. Kevin Riley, representing the American Institute of Certified Public Accountants. And Carolyn Stumpf, an IRS Public Affairs Officer from Indianapolis. Thanks for joining us. Also, during this hour, we will focus on the tax concerns of various groups of taxpayers, those who are married with children, singles, and seniors. Our Tax Break 93 reporter, Liz Miles, will be checking in with us. She's been out and about tracking down information which will make the preparation of your tax returns easier. You will learn about the basics, like which tax form is best for you, and about which items people tend to forget on tax forms. We'll remind you about those. Things that if you do forget will slow down your refund or affect the accuracy of your return. So we have an hour filled with the kind of information that will help you. Now, if you're not recording this program, get out a pencil and a paper and take some notes, because the more you know about filing your federal income tax return, the better job you can do. There's plenty of tax help you can get, by the way, over the telephone. If you want answers to your specific tax questions, you can call this number, 1-800-829-1040. 1040, this helps you remember. Or the number for your local IRS office, which you can find in your tax form instructions, will give you also a chance to call. The number's right there. When you call, you will receive tax assistance from a specialist. Now, you will find these specialists very helpful. It's a quick and easy way to get your taxes started. If you need tax forms or publications, here's another number to call, 1-800-829-3676. These numbers are open for your calls on weekdays from 8 in the morning till 5 p.m. On Saturdays, you can call from 9 a.m. to 3 p.m. And the IRS has publications on over 100 subjects. So if you really want to know a lot of stuff, they got a lot of stuff to tell you. If you want to know about deductions for your medical expenses, for example, or you want to know more about estimated tax payments, all that kind of thing you can find in these free publications. Okay, now the first thing we want to do is give our audience members a chance to ask questions of our panel. So let us see, panel people, how good you really are. Here's the audience. How many of you have questions for the panel? Good. Quite a few of you. All right, how about you? Start out and ask a question of anyone.
Anyone up there can answer this question. It has to do with the submission of estimates. After paying the federal tax and the state tax, many people experience a cash crunch. What happens if you do not submit your first estimate? Can you pick this up later, and is there any penalty?
I think you're talking about when you find yourself owing on April the 15th, and that's also the due date for your first estimated tax payment. What you should do is make that first payment just as soon as possible, because you could subject yourself to penalties if you do not. Now, try to keep up with your payments throughout the year, and then if you find yourself in a penalty situation, you may qualify for an exception.
What kind of exceptions, by the way, would be okay?
There are a variety of exceptions that would apply to an estimated tax penalty, and some of it depends on when you get your income during the year and how much you paid last year.
Is I'm poor at the moment a possible exception?
In general, that's not going to be an excuse.
Suspected not. Okay, next question.
I'm an entertainer, and when I'm called, for example, out of state, and I go to an audition, and they ask me to stay an extra day and come to a callback, and I come back the next day and do the audition again, then they tell me, okay, we want you to shoot this in a week, and I have to go back again. Maybe they pick up that part of it. What part of what, when I first go to the initial audition, is deductible?
He's crossing state lines once and then twice, and then you hang around for a while in that other state.
Basically, right.
I think if you're looking at it as your trade of business, that you're in trade of business as an entertainer, that any expenses related to your performing your job are deductible. This is not the normal commuting aspect where if you're just going back and forth to a job, commuting would not be deductible. But But in this case, you're leaving your normal place of business, you're going out of state, so those costs would be legitimate business expenses.
Okay, that sounds good. Part two of the question, too, is...
Oh, you have a part two.
Thank you. I did a benefit or two this year, and I wanted to know, how do you determine what you should essentially pay yourself for doing a benefit?
I've got that one, and that's an easy one because when you donate your time, you don't get a deduction for donating your time. So you can't take a charitable contribution for the value of your time donated. But if you're out of pocket any money for related to the charity, you can deduct that.
All right, let's move in this direction. A question from you.
Yeah, I'll throw this out to any of the three panelists, but I just recently graduated from a two-year business school, so I'm now in the process of printing and mailing out cover letters, inquiry letters, resumes, that sort of thing. I'm just wondering if the cost for those are tax deductible. You could see that coming.
Unfortunately, because this is your first job hunting experience, those costs are not deductible. But we would want to mention, since there are a lot of people who have previously been employed and are now looking for work, those costs would be deductible for them.
To go along with the same issue, one of the points you have is that if you were changing job functions, if you were going from a bricklayer to a lawyer, the changes that occur there would not be deductible either. So it's only if you continue in the same job market that those costs are deductible.
Well, thank you very much. Very good questions. Good questioners, good answers from the panel. That completes the first question and answer period. Now, as you are preparing your return, it will be easier for you if you had on hand the right background materials. We've mentioned that the IRS has free booklets and services that you may want to take advantage of. Liz Miles, our special tax reporter, will tell you more.
And it says on there, multiply 2,300 by the total number of exemptions claimed on line 6E.
This is a special tax session for self-employed people. It's free to attend and one of the many services provided by the IRS to help taxpayers. This group, organized as part of the IRS Community Outreach Tax Education Program, assists groups of taxpayers who have common concerns, like farmers or military personnel. All of the free tax services offered by the IRS are listed in this publication, number 910, and it's worth taking a look at. There are 7 pages of free publications listed. Here's one on selling your home. Here's another on tax rules for children and dependents. It's impressive, and I think you'll find many helpful publications on this list. The booklet summarizes other community services, such as Volunteer Income Tax Assistance, or VITA, where trained volunteers provide individual income tax assistance for taxpayers with special needs. Volunteers help those 60 and older with their individual income tax returns. The Small Business Tax Education Program helps small business owners with their tax responsibilities. These IRS programs are available throughout communities in convenient locations. Those who are interested in receiving this special kind of tax assistance can find out about it by calling your local IRS office. If you have specific questions about your tax return, you may know that the tax package, which most of you receive in the mail, covers many topics you may have questions about. And of course, you can call the IRS for assistance. One service is Teletax. There are over 140 recorded messages that you can access from a touch-tone phone. The number to call during regular business hours is 1-800-829-4477, or try your local IRS number. The Teletax subjects and telephone numbers are listed in the back of your tax package. Now, if you feel your questions are a little more detailed, you might want to try telephone tax assistance. The number is 1-800-829-1040. You'll get a chance to talk with helpful IRS tax assisters. Use your local IRS office telephone number if it's listed in your tax package. Forms and some publications are available in Braille for blind taxpayers at regional libraries for the blind, and services are also available at central locations for the hearing impaired. In IRS offices all around the country, you can find walk-in service where trained specialists will answer your questions. And finally, if you're looking for tax forms, they're widely distributed at most banks, post offices, and libraries. So, if you're seeking answers to questions, assistance programs, publications, or tax forms, the IRS makes it as easy as possible for you to find the information you require.
Thanks, Liz. That's a pretty wide array of free services. Don't forget about the order form in your tax package, by the way. Just list the forms and the publications that you need and send it in, and you should receive the items that you ordered within 2 weeks. Okay, we sent our camera crews out into the communities to ask people if they were clear on which tax form was best for them to use, and this is what we found.
I'm self-employed. What form do I use?
What's the difference between the 1040EZ and the 1040A?
If I put money into an IRA, does that mean I have to use the long form?
I just got married. Can my husband and I use the 1040EZ?
As you can see, people aren't always sure which is the best form for them to file. So for those of you who are also wondering about which tax form is best for you to use, we have prepared a quick look at the 1040EZ, the 1040A, and the 1040.
The green Form 1040EZ is a quick, simple way to go. Most people spend less than an hour completing it. To use the 1040EZ, you must be single, be under 65 and not blind, claim no dependents, and your taxable income must be less than $50,000 and be only from wages, salaries, tips, interest, taxable scholarships, and fellowship grants. Your taxable interest income must be $400 or less. You can't claim alimony payments or child and dependent care credit. You can't receive any advance earned income credit payments, and you can't itemize your deductions or claim adjustments to income or credits. The pink Form 1040A is often called the short form, and it too can be completed pretty quickly. For Form 1040A, there are no restrictions based on marital status, age, or dependents. Form 1040A is also for taxpayers whose taxable income is less than $50,000 and who don't itemize. But on Form 1040A, you can list more types of taxable income. As part of your income, you can list pensions, annuities, taxable Social Security benefits, and unemployment compensation, IRA distributions, and certain interest and dividends. You can take the IRA deduction, the child and dependent care credit, credit for the elderly or disabled, and the earned income credit. The 1040 gives you a lot of flexibility. The blue Form 1040, or the long form as it's often called, is for you if your income is from self-employment or other sources, you paid alimony, you itemized deductions, you received any non-taxable dividends or capital gain distributions or refunds from state and local taxes which are to be included in income for the year. Take special note that you must use Form 1040 if you have $50,000 or more of taxable income, but you can use it regardless of your income level.
So the lesson to take from this is maybe that anybody can use a Form 1040, Kevin, but you should probably only use it if you absolutely have to. Is that the idea?
That's correct, Robert. Not only will it save you time to use the right form, but it'll cut down on your chance to make mistakes.
And Carolyn, do you have to, are there some people who are filing tax returns who just don't have to?
There are quite a few people that do file returns and they don't need to, particularly those folks who are 65 and older and have lower incomes. If you have any questions about whether that applies to you, you should give us a call and we'll help you work through it.
Speaking of telephone numbers, if you need tax forms, you can make a free telephone call to the IRS's forms number. It's 1-800-829-3676, 1-800-829-3676. Operators are standing by to help you on weekdays from 8 a.m. to 5 p.m. and on Saturday from 9 a.m. to 3 p.m. Now, here is a change in tax regulations that business owners will be interested in.
If you own a business, you'll be glad to know that there are new, simpler rules for depositing payroll taxes, called federal tax deposits, with the federal government. Businesses that accumulate no more than $50,000 a year in payroll taxes will generally have to deposit only once a month. Businesses with bigger payrolls just twice a week, unless the accumulated taxes reach $100,000. If it's over $100,000, the accumulated payroll tax must be deposited next banking day. There are some other rules to know about. Ask for publication 937, Business Reporting, or call your local IRS office.
Okay, that sounds like pretty good news for business owners. Now let's focus on our first group of taxpayers, those who are married with children. Let's meet the Conrad family.
Bob Conrad is principal of a high school that specializes in the creative arts. He's been in teaching and school administration since he began his career in education more than 20 years ago. He and his wife, Jan, have 2 daughters, Karen, who's in college now, and Katie, who just graduated from college with a degree in art. The Conrads have questions about how their educational finances will affect their tax return. Karen, who is 19 and unmarried, was away at college for 6 months last year. They're wondering if they can claim her as a dependent. Bob's wife, Jan, received $2,500 from her employer for financial assistance toward her undergraduate degree. Does this money count as income? On the home front, last year the Conrads refinanced the mortgage on their home to take advantage of lower interest rates. They paid 2% of the refinancing loan, called points, to the bank. How to handle that payment is something the Conrads will need to know before filing their return. Looking ahead, the Conrads have been trying to save more for retirement. So Bob put money into an individual retirement account, commonly called an IRA. This is the first year he's done this because he does have a retirement plan at work. What tax help can we give the Conrads?
That's a pretty busy family. All right, audience, it is now time to test your tax IQ and see at the same time if we can help the Conrads. Now, here's how it's going to work. Using the buttons in front of you, I want you and the audience to answer each of the questions I put to you. The results will be instantly tabulated and will appear on the screen. Now, our panel will then discuss the answers, and I hope you at home will participate too, so here we go. This is question number 1. It's a true-false question. You supported your unmarried 19-year-old daughter. She was a full-time student away at school. You can claim her as a dependent. Is this true? Or is this false? So the audience will now decide whether it is true or false. Carolyn, you will get the answer. Here's the result. 88% of the people in this room believe that's true, 12% false. Are they right?
They are right. 88% are right. You can claim your daughter as a dependent. There are other people that you can claim besides your children, but your children do provide special rules so that, for example, she's away at college, you are supporting her, you can claim her as a dependent.
Okay, question number 2. Here's another one with an educational twist. For educational assistance provided by your employer, you can exclude from your income up to, first choice, $1,250. The second choice, $2,500. C, $5,250. There's a very, very generous employer. What is the right answer, A, or B, or C? Instant results. A gets 22%, B, 62%, C, 16%. Who's won? Is the audience right?
No, unfortunately, the audience is not right. The answer is C, $5,250.
Wow!
But there's another twist to this. The law that allowed you to take this deduction expired as of June 30th. Therefore, only amounts paid before July 1st are included in that $5,250.
So people who discover their generous employers after the midsummer don't get.
That is correct.
All right, let's go on to question number 3. We're 1 for 2 here in the audience. Number 3 is a chance to recoup. You refinanced your home in 1992 and you paid points up front. You may deduct the entire amount as interest for this year. The entire amount. Is that true or is that false? Well, the decision of the room by very, very close margins now is that it's false.
False is correct. Points or loan fees are actually prepaid interest, and they can be deducted over the life of the loan. So if your loan is 30 years long, you have 30 years to recover your loan fees. But if you happen to have refinanced your house in the past and you're carrying some unamortized loan fees, they can be taken in full because the loan's fully paid off. So watch for that if you did refinance this year too.
So you can catch up on your old points, but you can't.
There still may be a deduction there for you.
Okay, here's question number 4, and the subject concerns individual retirement accounts. The question is, which of the following determines whether you can take a deduction for your IRA? Number one, your modified adjusted gross income. Does it matter? B, your coverage under a retirement plan at work, if you have one, does it matter? Or both A and B? Let's see what the audience says. What matters to getting your IRA deduction? A, B, or both? A, 22% say A. B, 52% say B. And 26% say both. Kevin, what is the right answer to this question?
Well, the right answer is both.
Both.
I think what the confusion comes about is that B is probably the first step you go through. You first determine if you have a plan at work.
Right.
If you don't have a plan at work, you can make a contribution and take a deduction for your IRA regardless of your income level.
Regardless?
Regardless of your income level.
So you can make $1 million, and if there's no plan at work, you're entitled to an IRA deduction?
That's correct.
Okay.
But if you do have a plan at work, then there is a gross income limitation that comes into play. For example, for a married couple who file a joint return, if they're covered at work by a pension plan, the contribution they make to their IRA is only deductible in full if their income is less than $40,000.
I see.
If the income is between 40 and 50, it phases out, and once you pass $50,000, none of the contribution is deductible.
So in that case, the millionaire with a pension plan is out of the picture.
That's correct.
Okay, here's the last question in this section, and it's about something many of us would like to know. Here's a proposition I would like to make to you. Getting an automatic 4-month extension to file your return also gets you a 4-month extension to pay the tax. Is that true or is that false? Let the audience decide whether if you get a delay in filing, you also get a delay in paying. The answer is 29% think that they can postpone their payment, 71% think that there's no way in the world. Are they right?
They are right.
I'm not
False is
surprised.
the answer. And that is a very popular misconception, that an extension of time to file also gives you time to pay. It does not. With the extension of time to file, you should make all of your tax payments, or at least 90% of them. One thing we do want to advise people, if you find yourself in the position of owing, go ahead and file the tax return, and we'll get with you and make some arrangements to pay at a later date.
Okay. You know, last year, millions of federal income tax returns had taxpayer errors. Claudia, what can you tell us about this problem? Because people do make them all the time.
Well, taxpayers seem to make the same mistakes every year, and they're simple mistakes. Changing the numbers in their Social Security number, personal exemption, standard deduction amounts. And when you make these kind of mistakes, it prolongs the time you wait to get your refund.
But we're only human, and to be human is to err, right? So what do you do?
Probably the simplest thing to do is to finish the return, set it aside, take some time, come back to it fresh, and double-check your math and the numbers on the return before you mail it.
I see. Give yourself just the pause that refreshes, is the advice. We'd like to focus your attention now on some other important reminders.
Make sure you use the peel-off label. It's a self-stick label and will adhere easily. Put it in the name and address area of your return. If you've moved, remind yourself to inform both the IRS and the post office about your change of address. Make your address changes right on the peel-off label. When you mail your 1992 tax return, be sure to do so in the pre-addressed envelope.
Okay, those are pretty basic reminders. Now I want to know, what records should an ordinary taxpayer have ready when it's time to do your taxes? Kevin.
Well, there's a few things they should do, but the first thing they should do is make sure they have all of the records they might need all together in one place before they get started. Some of the more common records they're going to need are their Form W-2 that they've received from their employer. The other things is if they are an independent contractor or do work on their own, they may have a Form 1099 miscellaneous. This is a form that is supposed to be given to them by people they work for. The other forms that they may get would be other forms in the 1099 series, including 1099 INT from the bank, or maybe some others for dividends or brokers or things of that type.
Just have them all with the paper clip firmly attaching them so you know they're all there.
So they're all in one spot.
Okay, let's suppose now that you're itemizing, okay? Is there a different set of things that you should have at hand?
In addition to what Kevin's mentioned, if you plan to itemize, you'll need to organize your expenses for medical and dental expenses, for taxes that you've paid for property taxes, real taxes, interest deductions. You should have a Form 1098 from your lenders to substantiate the interest deductions. If you have charitable contributions, you'll need to review those. And if you have employee business expenses or investment expenses, those should be gathered together at this time, too.
So you look at the categories you have to deal with, and then you organize the paper by appropriate category.
Right.
Be a good way to begin. Okay, that is more good advice. One service the IRS is emphasizing is helping non-filers. These are the people who should be filing a tax return, but who are not. And Liz Miles has prepared this report.
Did you ever check a book out of the library and forget to take it back? Eventually, you owe the library a lot more than you should. And worse yet, you might stop using the library altogether. Well, the IRS has a problem similar to the libraries. People who don't file a tax return one year, for whatever reason, often stop filing entirely because they fear being detected or are unable to pay the tax owed. This applies to businesses, too. Millions of businesses do not file tax returns each year. Whether you are an individual or a business taxpayer who has not filed lately, the IRS wants you to know that it has geared up its assistance efforts to help you start filing again. What are these assistance efforts? Well, for one thing, the IRS intends to review the facts in each non-filer case to determine if the taxpayer is entitled to a waiver from penalties for failure to file and pay on time. In addition, local IRS offices around the country now have copies of prior year tax returns, and IRS employees have been trained to help taxpayers reconstruct old records, such as income statements, needed to prepare old returns. The IRS is also working with local tax practitioner organizations to provide assistance in convenient locations throughout a community. The IRS wants to make it clear that this effort is not an amnesty program. However, those taxpayers who come forward voluntarily to file their delinquent returns should not fear criminal prosecution. The IRS will not recommend criminal prosecution of any taxpayer who makes a true voluntary disclosure and files an accurate tax return. If the inability to pay is a problem, the IRS will work with taxpayers to set up installment payment plans when the situation warrants. They have streamlined procedures for collection of tax debt, offering alternatives for taxpayers who cannot pay in full. Non-filers should be aware that non-filing is costly to everyone. The IRS estimates that more than $7 billion in tax revenue is lost annually due to non-filing. And the cost to non-filers is steep. Interest and penalties continue to accrue on amounts they owe. Some non-filers may have refunds coming, so they may be losing out on money the government owes them. Why do people stop filing tax returns in the first place? IRS research indicates that many people do so because of a personal problem, such as a divorce or death in the family or a business reversal. So if you find you're in this non-filing category, you should be aware that the IRS has reviewed its records to identify non-filers and is reassigning 2,000 examining agents to begin contacting you. So think about getting your books in order and making things right with the government.
Okay, it's time to look at single taxpayers with children. Let's meet Isabel Parks and family.
On weekdays, Isabel Parks supplies the vehicle and does the driving for her work carpool.
Flag, flag, flag. Good girl. Good girl. Eyes up a little more, okay? Good girl. Very good.
She teaches horseback riding at a local stable and horse farm, preparing riders for appearing in a variety of equestrian competitions and shows.
That's it. Make a circle and then go around the big circle.
At home, Isabel is mother and head of household for her 2 children, 10-year-old Christine and 5-year-old Mary. On school afternoons, Isabel hires a neighbor college student to watch over the kids until she gets home. She's wondering whether she qualifies for a child care deduction. The Parks faced some medical problems last year when Christine broke a leg in a bicycling accident. She's fully recovered and still enjoys bike riding, but Isabel wants to know if their extensive medical bills qualify for a tax deduction. Since this will be the first year she'll be preparing her tax return as a single parent, and with a salary of $23,000 plus child support, Isabel is unsure whether she should file as a single person or as head of household. These are all important questions which will directly raise or lower the tax she'll pay for 1992. Can we help her out?
I think so. Let's ask these questions of our studio audience and of you at home. Here's question number 1. A single parent with an income under $50,000 will pay less, remember, under what filing status? Less if the taxpayer is single is A, B, head of household, or C, married filing separately. Under which category would the taxpayer pay less? A, B, or C? The computing people are computing. Here's the result. B, an overwhelming vote for B. What is the correct answer?
84% for B. That is the correct answer, head of household with a dependent.
Okay. All right, so you guys are right. Question number 2. This next question is about Isabel's carpool. The money Isabel's passengers pay her is taxable. Is this true or is this false? Compute, please, and decide whether you think the money she gets from the other passengers is income to her. 60% of the people in the room think the answer is no, it's not. What's the right answer?
And they are correct. The
Aha.
answer is false, that carpool income is not taxable to Isabel, and we're assuming that she's not in this as a business, so carpool is an exception to the taxable income rule.
Question number 3. The Parkses had substantial medical bills last year. To be deductible, medical expenses must exceed what % of your adjusted gross income? That's the question, and here are your choices. A, 5.5% of your adjusted gross income, B, 7.5%, or C, 10%. So the question then for the audience is, how much money do you have to pay the doctors, nurses, and hospitals when you're sick? The proportion of your income to qualify. And they chose the happy medium here. B, 57% vote B. What is the correct answer?
That is the correct answer.
Oh.
To be deductible, your medical expenses have to exceed 7.5% of your gross income. But remember, only the amount that exceeds that 7.5% is deductible.
Oh.
And if you pay any premiums for medical insurance, that would go into the total.
So it's not as generous as it seems at first glance. Okay, question number 4. Isabel receives a salary. She also receives child support. Which of the following types of income are not taxable? Not taxable. Here's the list. A, child support. B, the money she receives from her second job income. C, the money she receives from alimony payments, received alimony payments. All right, you audience, you choose among the 3. Well, 71% choose A as the item that is not deductible. Are they correct?
They are correct. Child support payments received are not income to you, nor are they deductible by the person paying them. Alimony is income, and it's deductible by the person who pays it.
Question number 5. Isabel pays $50 per week for child care. This amount qualifies her for the child care and the dependent care credit. Is this true or is this false? Take a look and see what the audience thinks. The answer is yes, she's entitled to both, says a squeaky majority here. A, 53%, B, 47%. What is the correct answer?
The correct answer is true. She is eligible for the child care credit. The way the credit works is the higher your income, the lower the amount of credit you're eligible for, but you still are eligible for a credit. One thing you should watch out for and one thing you should do is to make sure you get the social security number or the employer identification number of the child care provider, because you need that information to take the deduction on the return.
So ask the person who's helping out at home with your child for her big number or his big number.
Right.
Okay, question number 6. Isabel's gross income in 1992 was about $23,000. To qualify for the earned income credit, your earned income and adjusted gross income must be less than, here's 3 numbers. Must it be less than $25,500? That's A. Or less than $22,370? B. Or less than $19,000 is C. Again, we're going to ask you out there to compute. Let's just press the button that indicates your choice. And then on our magic tabulator here, the answer, B. They've chosen B. Is that correct?
And B is the correct number, so Isabel would not be entitled to earned income credit. We would like to note that the earned income credit amount this year is $2,211, so that's a substantial amount of money if you do qualify for the credit. And of course, though, the more you earn, the less credit you get, so there's a computation that has to be made.
What's the number again?
$2,211.
$2,211. Okay, that finishes our questions and our answers for this section. Now let's take a moment to see what other reminders will make preparing our tax return easier.
After you've finished your 1992 tax return, double check to be certain you have filled in all the appropriate lines and boxes. Here's another easy error to make. Make sure your correct Social Security number is on the form. And if you enter a spouse's or a dependent's number, triple check those numbers to see that they're correct.
Thank you. We've heard a little bit about the earned income credit thus far. It's an important credit that many people may not know about. Liz Miles researched the subject and has this report for us.
My refund doubled this year because I qualified for it.
I'm paying $800 less in tax this year because of it.
A friend told me about it. It's the best thing she ever did for me.
The IT these taxpayers are referring to is the Earned Income Credit, or the EIC as it's called. This credit is a unique feature of our tax law. It's a refundable credit, which means that you can receive it whether you owe federal income tax or not. If you think you'll qualify for it next year, you can receive some of the credit in each paycheck in advance. You qualify if you work, your income is less than $22,370, and you have one or more qualifying children who have lived in your home for more than 6 months of the year. The Earned Income Credit consists of 3 separate credits. You can receive any or all of them if you qualify. The basic credit is determined by your income level and number of qualifying children. The maximum credit with one qualifying child is $1,324. With 2 or more, it's $1,384. To receive the credit, you must have a qualifying child. That means that the child under the age of 19 or the age of 24 if a full-time student has lived with you in your main home in the United States for more than 6 months of the year. There are no age restrictions for permanently and totally disabled children. A qualifying child can be a grandchild, stepchild, adopted child, or a foster child. Foster children must have lived with you for the entire year to qualify. And keep in mind, since this is a credit, the amount you qualify for reduces the tax you owe dollar for dollar. And if you don't owe any tax, you'll get a refund. The second feature is a health insurance credit. This credit may be claimed if you paid for health insurance that included coverage for a qualifying child. The amount of the credit you receive depends on how much you paid for the health insurance and the amount of your earned income and adjusted gross income. The maximum health insurance credit is $451. This credit is figured on the amount you paid for the cost of the insurance. It does not apply to payments for doctor visits and the like, or for health insurance paid by your employer. The third feature is an extra credit for taxpayers who have a child born in 1992. You can receive up to $376 for this credit, and it can be taken in addition to the basic credit and the health insurance credit. Whether you owe taxes or not, you can still qualify for the credit. No matter what your situation, you'll need to file Schedule EIC with your income tax return to receive the credit. If you like, the IRS will figure the tax for you.
Okay, it's time to consider tax issues of importance to older Americans. And now we'd like you to meet Leo Struthers. Let's see what tax issues his situation raises.
Leo Struthers is retired, but you'd never know it. His hobby is piloting flights for skydivers. Leo's income is from Social Security and pension payments from his prior employment and from a rental property he owns. Leo would like to know what portion of his income is taxable. Leo is also an active war veteran. He contributes his time and energy to a veterans organization, and in addition, makes charitable contributions to their fund drives. He wants to know what part of his charitable work is deductible. For the past 30 years, Leo has lived in the same house, but with all the care required, he's thinking about selling it. He estimates that there will be about $100,000 in profit over the purchase price of the home. Since Leo does not plan on buying another home, he's wondering how much tax he will have to pay on the gain from the sale of his house. Can we give Leo some answers?
I think we can do that. Let's see what questions we have. This is the first one, and it's a common question for many of our senior taxpayers. Here it is, question number 1. Leo Struthers is receiving pension income. What part of his pension is taxable? A, all of it. B, the part that does not represent his cost in it. And here is your chance to choose between the two. Is it A or is it B? And let's see what you people have decided. It is B, but not with much conviction. What is the correct answer?
B is the correct answer. Leo's already paid taxes on his own cost in the pension. For many people, there's no cost to the pension because the employer's provided it, and then it would be fully taxable. The person should be receiving a Form 1099-R, which should break out the part of the distribution that was taxable to them during the year.
So if they get the 10, what is it?
It's a 1099-R for
1099-R.
pension distributions.
And that's
Yes.
where the answer would be.
Most of the times. If it isn't there, then they need to go back and look at their cost in the pension and make the calculations to see what portion is taxable.
Okay, here is the second question. So far, we're 1 for 1 in this section, so let's keep going. Leo also receives Social Security. Social Security income, this is a proposition now, is never taxable. Is that a true proposition or a false one? True or false? Social Security is never taxable. Only suspicious of the word never, as is our audience. 78% of us here in the room say that's absolutely wrong. Are we absolutely right to believe this?
That's correct.
Yeah.
Social Security sometimes is taxable. And the thresholds that you should watch out for are if you're single, it's $25,000, and if you're married filing a joint return, it's $32,000. There's a worksheet in your tax booklet that would really help you out with that if you meet either of those income limitations.
So above a certain income level,
it could be taxable.
It could be taxable. Question number 3. Leo receives rental income. Generally, this is a proposition I want you to think about. Generally, amounts you receive as rent must be included as income. Is that a true proposition or a false proposition? A for true, B for false. And let us see what the room decides, which is running a mean streak here, this particular group. This is an overwhelming vote for the truth of the proposition.
And they are correct.
And they are correct.
Rental income is taxable, but what you have to realize is that you can also have expenses that relate to the rental income. Those expenses may be deducted from the income, and you only have to report the net. Now, you would do this on Schedule E of Form 1040.
Okay. Question number 4. If Leo sells his home for a considerable profit, lucky man in this market, he may not have to pay federal tax on the gain because he qualifies for the once-in-a-lifetime exclusion. To qualify for this once-in-a-lifetime exclusion, how long does a homeowner have to live in his house? Here are 3 rules. One of them is correct. A, he or she must live in the home 3 out of the last 5 years. B, 10 out of the last 15 years. C, 20 out of the last 30 years. Which is the one most of you think is the correct proposition? A, B, or C? And the answer is A, a sizable plurality for A. Are they right?
That is correct. 3 out of the 5 years prior to the date it's sold. There's some other important reminders on this one, too. You must be over age 55 at the time it's sold. This is a fantastic opportunity for people because they can exclude up to $125,000 of gain if they meet the requirements. One thing to watch for is for couples who remarry later in life, you've got to be careful because it's a once-in-a-lifetime, and if you marry someone who's taken their exclusion, you won't be able to take it yourself.
Oh, really?
Yeah.
So before marrying, you have another question to ask.
Right.
All right. Question number 5. Leo made contributions to his Veterans Association. Now, here's the question. You may not deduct contributions for which of the following? A, veterans groups of the sort that we just described Leo contributing to. B, civil defense organizations. Or C, political groups. All right, let's see. Which is the not category? A or B or C? And the answer is C, political groups. What do you guys, what's the real answer?
The real answer is political groups.
Political groups.
The deduction is allowed for veterans organizations and civil defense. With political groups, the contribution is never allowed. But again, another reminder, the deduction is never allowed.
Okay.
Another reminder that you still must itemize your deductions in order to take these contributions.
Okay. Before we move on to our final set of audience questions, we have a few more things to do. First, let's turn another page in our tax notebook.
If your property was damaged or lost in an area that the President declared eligible for federal disaster assistance, you may be able to deduct a casualty loss on your tax return. Get publication 547, Non-Business Disasters, Casualties, and Thefts, to learn more about this and other casualty and theft losses.
That's good advice. And now our tax reporter is ready with her final report. It's about a fairly new way of filing your tax return, electronic filing. More and more people are filing their tax returns this way, and we thought we'd find out more about it. Liz?
Electronic filing. It's the ability to transmit your federal tax returns by computer directly to the computers at the IRS. Last year alone, over 11 million taxpayers filed their returns electronically. If you're getting a refund, you can get it back within 3 weeks rather than the usual 6 to 8 weeks when you file by mail. And you can have that refund deposited directly into your own bank account, so you don't have to worry about the check getting lost in the mail. Even if you owe money, you can file electronically. The system for filing electronically is simple. If you have your taxes prepared by an outside tax accountant, ask him or her about electronic filing. Your preparer may already be an accepted IRS electronic filer. If not, he or she may be able to route your return through an accepted service bureau or help you find a transmitter. When a tax transmitter prepares your return, you will need your Forms W-2, wage and tax statement, and you will need to sign Form 8453, the signature document for electronic filing. The cost for the service may be included in your tax preparation fee or broken out separately. If you fill out your own tax return, you need only find a local business that offers electronic filing services. They will enter the data, have you sign the signature document, and send it on. Fees for electronic filing are set by the individual transmitters, so it may be to your advantage to shop around. Whether you prepare your own return or not, the IRS will acknowledge receipt of your return within 48 hours of transmission. When electronic filing began in 1986, it was in direct response to making the process of tax filing more efficient. Electronic filing is a highly cost-effective innovation. This disk, used to store electronically filed returns, holds the equivalent of about 3.5 million paper tax returns. You can see that the amount of paper saved alone is staggering. So it's no wonder that millions of taxpayers are filing electronically. If you haven't tried it, look into it. It may be just what you're looking for.
Thanks for all your reports today, Liz Miles. You brought a lot of helpful information to our attention. It is now time for the second question and answer session. How many of you have questions still? Oh, many of you have questions still. All right. All right, how about you? Oh, right by my side. Up you go.
I plan this year to file my taxes electronically. However, I've heard that if you do file electronically, you have a greater chance of having your tax audited. Is there any truth in this feeling?
Well, I'm happy to say that there's absolutely no truth to that. Electronic filing is a great way to file your tax return, either when you owe or when you get a refund. And particularly if your refund return is filed that way, you'll get it faster. I might also add that including with that myth is the myth about filing a tax return and using your label. People think that if you use that pre-addressed label that comes with your tax package, that there's some mysterious audit code there, and that is not true either. So neither one of those things have anything to do with your being audited.
Yeah.
I received a small amount of, I received some money from a relative who passed away recently. I'm wondering, do I have to pay taxes on that money?
That's a very good question. There is no income tax consequences to your receiving money via a will or something, a bequest. There is no income tax consequences to you. Whether there's estate tax consequences or any of those items, that all is based on the estate. But for you yourself, you do not have to pay tax on that money.
Regardless of how much money it is?
Regardless of how much money that is.
Are you thrilled?
Yeah, I think so. I hope so.
Anyone else? Yes. Oh, okay.
I am giving my grandchildren savings bonds for their college education. They're age 4 to 12. What are the consequences, or whose name do I put the bonds in so that my daughter and my son will have that for their children?
That's a good question, and I think it's great that you're making the gifts to your grandchildren. A lot of people have questions about at what point a child with investment income has to start reporting it. And children under 14, the investment income they earn gets taxed at their parents' rates once it exceeds, I think, around $1,100. So, but you have a special choice if you have savings bonds that you're giving them, because the children have the choice of not reporting the income earned or accrued on the savings bonds until they cash them in, or reporting it, making an election to report it annually. Sometimes it's better for them to elect to report that income annually on the savings bonds so that the time they're cashed in, they don't have a large amount of income all in one year.
Do you mean annually up to age 14 or beyond that too?
No, once you make an election to treat the accrual as income, you have to treat it that way consistently on the bonds you elected to do it on.
Thank you.
One of the important things going along with that is to make sure that the bonds are in the name of the children. Because if they're in the name of the parents along with the child, then the parents will have to report the income.
All right, can we go all the way to the corner? This is the outer reaches of our audience. Your question.
Sir, I have a friend who regularly does cleaning work, part of her livelihood. Now, once a week, or at least twice a month, she comes to me for the same reason. Now, I don't pay her like her rich clients do, but I do pay her. So my question is now, do I have to pay any of her federal income taxes?
Did you guys hear the question?
Okay, there's a general rule to follow there, and that is if this person who's doing the cleaning for you got her own business, she's in business for herself, she's self-employed, then she's not your employee. So you would not have to have any responsibility for her income tax withholding or her Social Security tax withholding. So that's the defining factor there.
Thank you very much, panel, and thank you all. That completes our questions and answers, and thanks for the good work. Now, some final reminders.
Remember to sign your name and date your return. If you forget, your return cannot be processed, and you may be subject to late penalties and interest charges. And when you do sign, do so carefully and legibly. And finally, before you mail your return, put enough stamps on the envelope. It may seem too obvious even to mention, but it is a common mistake. And remember, many tax returns require more than one stamp.
Okay, panel, before we end the program, I want to give you one last chance to impart any final pearls, a piece of advice you think the audience ought to know, but somehow or other has been left out of this presentation. Anything from any of you?
If you want to check the status of your refund, call the Teletax service. You do that by dialing 1-800-829-4477 or the local number for your city listed in the Teletax page of your tax form instructions. You'll need to know your Social Security number, the amount of the refund, and if you filed your return as single or married. This service will provide you with a mailing date for your refund. Allow 3 to 4 weeks before you call.
So after 3 to 4 weeks, you call this number and you ask, where's my money? And they'll tell you when they're going to mail your money to you.
You're talking to a computer. Oh. So basically you answer their questions using the touch tone on your phone.
Okay, so the computer tells you. But the computer knows when it's supposed. Okay, anything else?
Well, it's something we've mentioned, but we need to reemphasize it. It's the earned income credit. This year it's increased for those with gross income under $22,370. It's worth looking into. The credit can substantially reduce your tax, and you can even get it up front.
Okay. Anything else?
I have one more final tip.
All right.
The IRS would like for you to file your return as soon as you possibly can, but by the same token, don't get in such a hurry that you forget important things like your W-2s and your 1099s, all of your income. So get everything together, get your return pulled together, prepared, set it aside for a day, look it over, and then get it to us as quickly as possible.
All right. Anything else?
File
Oh, another one. All right, yes, one more.
File electronically. If you have a refund coming, you'll get it faster this way. And ask for direct deposit.
Good advice and much appreciated advice from our panelists. Thank you very much. And thank you, audience. You did a terrific job. And remember that you can telephone an IRS office during regular business hours with your questions. And the number is 1-800-829-1040. That's 1-800-829-1040. If you're calling about getting forms or publications, that number is 1-800-829-3676, weekdays during business hours, also Saturdays, 9 a.m. to 3 p.m. Well, we've enjoyed this opportunity to provide you with as much tax information as we could on this program. My thanks again to all our participants and especially to you, our viewers at home. We appreciate your interest and we hope our program makes your tax preparation easier. Thank you.
On this eve of Passover, join us for a special WHYY production, The Talmud and the Scholar. That's coming up next here on TV 12.
Everyone here is critical. You begin to wonder if there's such a thing as a healthy person.
And I feel that I'm almost paranoid when I go to the doctors now.
I'm concerned that we end up doing things to patients and not for patients.
Medicine at the Crossroads.
Monday night at 9 on TV 12.
Next time on Frontline, what's wrong with baseball?
I've stopped liking baseball because I don't count. You don't count. The game is not played for us.
Frontline examines the struggle between millionaire players and owners for control of the game.
I think one of the things that's really hurt baseball is that now we focus so much on money.
The Trouble with Baseball on Frontline.
Tuesday night at 9 on TV 12.
It's a film you shouldn't miss, a film you won't easily forget. An unflinching look at the criminally insane, so controversial it was banned for 24 years. Frederick Wiseman's Titicut Follies. It's a film you shouldn't miss.
Tuesday night at 10 on TV 12.
Saturday, it's a holiday treat.
Oh, bells of St. Mary, we always will love you.
The Bells of St. Mary's, Saturday night at 8. Then, Gene Simmons.
If I don't behave, I shall be thrown to the lions. And if I do behave, I shall be thrown to the lions just the same.
Victor Mature. How is it possible for them to sing when each day brings them nearer to death?
And Alan Young as Androcles in Androcles and the Lion.
Saturday night at 10:15 on TV 12.
You're watching TV 12, WHYY.